Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Zeta Global.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And to kick things off, I want you to imagine a business scenario for your own portfolio that just totally defies normal corporate math. You secure this massive strategic partnership. It's projected to bring in over $100 million in new annual revenue.
Which is massive for a company of this size.
Exactly. But under normal market conditions, generating that kind of top-line growth requires, well, significant capital expenditure. You've got to scale up server infrastructure, expand your engineering headcount, increase your marketing spend, right?
Right, you accept a temporary hit to your margins to capture the growth.
Yeah, exactly. But in this scenario, the operating expenses required to capture that new $100 million will increase by exactly zero.
Wait, literally zero. How is that even mathematically possible?
It forces a complete recalibration of how you value a software business. When the marginal cost of delivering a new product approaches zero, every incremental dollar of revenue flows directly to your free cash flow. In the physical world, or even, legacy tech, this is impossible.
Because you always need more data centers or more compute power.
Right, or more sales engineers. But what we're looking at today completely sidesteps that traditional growth penalty. And before we get into the exact mechanics of how Zeta is pulling off this zero OpEx miracle, I just want to mention that tracking these structural market shifts requires the right tools.
Yeah, absolutely. If you want to visualize these institutional momentum plays on your own charts, you can check out VIP Algos. The link is down below in the description. It's an incredible educational chart suite.
We'll talk more about how traders use tools like VIP Algos later, but going back to Zeta, going into June 2026, their baseline data already looked incredibly strong for a mid-cap marketing tech play.
Yeah, they were compounding at 29% revenue growth, right?
It's exactly, 29%. And their average revenue per user was expanding steadily. But then on June 23rd, they announced a 7-year strategic partnership with Palantir that just completely changes the game.
Because it doesn't just bolt on a new product feature, it basically alters their corporate DNA. They're shifting from a standard marketing software provider into a Tier 1 AI infrastructure play.
And the magnitude of this shift really comes down to the underlying architecture. Zeta is effectively deprecating heavy elements of its proprietary data cloud. They're taking their core intelligence layer, which they call Athena, and migrating it directly onto Palantir's Foundry platform.
Which is wild because Palantir operates in the highest stakes data environments on the planet. I mean, they manage localized ontologies for defense contractors and in global supply chains.
Yeah, and now Zeta is tapping into that hardened infrastructure.
But see, that architectural migration is exactly where I want to push back on the initial market euphoria, because giving up your proprietary data pipeline, Claudia, carries immense risk.
How?
Well, if Zeta abandons its own underlying data infrastructure to live inside Palantir's ecosystem, aren't they surrendering control over the very compute layer that makes them a tech company?
I see what you're saying.
They basically become entirely dependent on a third-party vendor's roadmap at that point.
They do, but that dependency is the exact trade-off management is willing to make to achieve a capital-light growth vector. I mean, maintaining a proprietary data pipeline in the current AI environment is a massive drag on operating margins.
Because you're constantly fighting technical debt, upgrading security protocols, paying cloud compute costs.
Exactly. It costs a fortune just to keep the servers running. So by shifting Athena onto Foundry, Zeta offloads that entire infrastructure burden. Foundry acts as the unified data layer. It handles the immense compute requirements.
Oh, I see. And then Athena just sits on top of that unified layer.
Right, executed the complex marketing logic and the AI routing.
So the zero OpEx projection suddenly makes structural sense. Palantir absorbs all the heavy lifting of the data, backend, and security.
Yeah, so when Zeta acquires a massive new enterprise client, or they upsell an existing one, they don't have to spin up new infrastructure. They don't have to hire a whole new engineering team to handle the data integration.
They just route the API calls through Foundry.
Exactly. The infrastructure costs are essentially fixed, or at least heavily subsidized, by the Palantir partnership. And that allows that new $100 million revenue target to expand operating margins in a way a standalone software company could never model.
Which means Wall Street is being forced to completely rethink Zeta's valuation multiple.
They have to. A traditional marketing software company is valued on its gross retention and acquisition costs. But an AI infrastructure company, integrated deeply with Palantir, commands a structural premium because the revenue quality is so much higher.
Yet, despite all that, the stock is currently trading at roughly 21 times forward earnings, which, if you look at the broader enterprise software sector, represents a 15% discount compared to the median.
Yeah, the market clearly hasn't fully digested the margin implications of this architectural shift yet.
But if we look at the quantitative sentiment scoring from institutional news feeds, the bullish thesis is already registering an 8 out of 10. We are seeing major analysts, specifically Wedbush, praising the deal.
And they're not just praising it as a cost-saving measure either. They're calling it the foundational framework for agentic marketing.
Agentic marketing. Let's break that down for the listeners because it moves the industry way past the predictive models we've seen over the last decade.
Oh, entirely. Rather than software acting as a passive tool where, human marketers sit there and query databases to build target lists.
The AI agents operating within Zeta's Athena layer have direct read and write access to the campaign parameters themselves.
Right. Given a broad objective and a budget, these autonomous agents can query the Foundry data, identify microsegments, generate the creative copy, deploy the capital, and then continuously adjust bids in real time based on conversion data.
It basically eliminates the human bottleneck in marketing operations.
Completely. And when you power an autonomous agent with the sheer data density of Palantir's Foundry, the moat becomes nearly impenetrable.
Because enterprise software already benefit from incredibly high switching costs.
Right. Imagine a Fortune 500 company integrates Zeta and Palantir into their daily revenue operations. The friction of ripping out that foundational data layer just to switch to a competitor is catastrophic.
A standalone marketing software product simply does not have the integration depth or the security clearances to compete against a joint Palantir deployment.
Which creates this bifurcated market. You have the integrated AI heavyweights on one side, and you have the legacy point solutions on the other, and those legacy ones are slowly being starved of capital.
And institutional asset managers are definitely recognizing this dynamic. Tom Lee recently added Zeta to the small cap granny shots ETF.
Which is a huge quantitative signal. Funds like that target specific structural advantages. They're screening for high momentum, high margin expansion potential with a favorable asymmetric risk-to-reward ratio.
And they're looking at Zeta's 15% sector discount and seeing a severe mispricing.
Right, and the retail side of the market is picking up on that institutional positioning as well. The message boards are dissecting the fact that Palantir and Zeta have forward-deployed engineers physically working side by side to build out these integrations.
Oh yeah, when you combine deep technical interweaving with shared engineering resources, the obvious speculation is that Palantir might eventually acquire Zeta outright.
I mean, it would serve as their permanent native marketing vertical. A buyout is honestly the logical conclusion for a partnership with this level of embedded integration.
Because Palantir is notoriously protective of its ecosystem.
Exactly. If Zeta proves that Athena can successfully monetize Foundry's data layer at scale, internalizing that revenue stream makes perfect strategic sense for Palantir.
And the market mechanics are already reflecting this anticipation. We can see that playing out vividly on the tape. On the day of the June 23rd announcement, Zeta's stock surged over 6.5% to close at $19.66.
But the underlying technical setup is what really validates the institutional conviction. Prior to the news hitting the wire, the stock had established a hardened support level right at the $19 mark.
The volume profiling on the announcement day confirms that institutional accumulation, too. Over 4.66 million shares crossed the tape, rapidly tracking toward the daily average of 8.69 million.
And when you see that level of liquidity being absorbed without the stock spiking out of control and immediately giving back the gains, that's telling you something.
It indicates that larger players are stepping in at these structural valuations to build long-term positions.
Right, rather than just day trading the headline volatility. That $19 support level didn't just materialize out of nowhere. Institutional algorithms leave footprints on the chart.
They establish buyer walls where the long-term value thesis outweighs the short-term market noise. The challenge for the everyday trader is recognizing those footprints before the broader market reacts.
Which brings us back to VIP Algos. This is exactly why technical traders rely on overlay suites to visualize the order flow and momentum shifts.
Yeah, VIP Algos functions as an educational chart analysis suite that integrates directly into platforms like TradingView. It basically translates the chaos of volume metrics and moving averages into clear visual data points.
By mapping out historical liquidity zones, Tools like this help traders identify where those $19 support floors are located, and conversely, where overhead supply might create resistance.
Like as the stock approaches its 52-week high of $25.95.
Exactly. It also clarifies the broader momentum through trend direction indicators, signaling when a stock is breaking out of a consolidation phase. But the real utility of visualizing those support and resistance zones is risk management.
Because high beta tech stocks reacting to AI partnerships are inherently volatile. Mapping out your expected value requires precise take profit and stop loss planning.
You have to know where your thesis is invalidated before you ever allocate capital. It is entirely about defining your risk parameters.
A suite like VIP Algos allows traders across equities, forex, and crypto to visually map their risk-to-reward ratios right on the chart. But of course, we need to be clear about the regulatory guidelines here.
Right, absolutely. These are strictly educational tools designed to assist in technical analysis. They do not constitute financial advice, they do not guarantee profitability, and they do not execute trades or manage accounts on your behalf.
While market participants are entirely responsible for their own risk assessments, we are definitely not telling you to buy or sell any asset.
And that risk assessment is critical right now because while the zero OPEX math and the institutional accumulation paint an incredibly bullish picture, no technical setup is immune to macroeconomic gravity.
We have to map out the bear case for Zeta.
We do. And the most immediate threat is pure execution risk. That $100 million revenue projection is a multi-year forward estimate.
Right, and Palantir's core client base leans heavily toward government agencies, defense contractors, and highly regulated legacy enterprises.
And those are historically the slowest sectors to adopt bleeding-edge marketing automation.
So if the sales cycle for the new Athena Foundry integration stretches from, say, 6 months to 18 months, those forward revenue estimates will collapse.
The market is currently pricing in a frictionless deployment. They're assuming that because the engineering is sound, the enterprise adoption will be immediate.
But if Zeta hits a wall integrating their data structures, or if Palantir's clients simply don't see the return on investment for agentic marketing, Wall Street will punish the stock relentlessly for missing those elevated targets.
And there's a much broader systemic risk hanging over this entire sector right now. The market is currently grappling with what's being called the SaaSpocalypse.
The SaaSpocalypse. Yeah, over the last decade, traditional software-as-a-service models commanded massive profit margins and sky-high valuation multiples because their product was highly scalable.
You build the software once, and the cost to duplicate it for the next user is negligible.
But generative AI is rapidly commoditizing the ability to write code. If an internal AI agent can spin up a bespoke marketing tool in a matter of seconds, the justification for paying massive monthly subscription fees for a generic SaaS product just disappears.
We are seeing massive valuation compression across the tech sector because of that exact fear. The market is aggressively repricing software companies that lack a defensible moat.
If your entire business model is just wrapping a user interface around a database, generative AI will render you obsolete. The barrier to entry for software creation has collapsed to near zero.
Which brings us to the core tension of our analysis today. If the market is indiscriminately punishing software margins, why is Zeta seemingly immune to this SaaSpocalypse?
I mean, they are fundamentally a company that sells software to marketers.
The distinction lies in their pivot from software application to data infrastructure. The Palantir partnership is the ultimate mitigation strategy against AI margin compression.
So Zeta is no longer selling an easily replicable user interface. They are selling the deep, foundational data intelligence required to make the AI function accurately in the first place.
Exactly. Generative AI models are entirely dependent on the quality, security, and harmonization of the data they ingest. By embedding Athena into Foundry, Zeta becomes the beneficiary of the AI trend, not the victim.
They're providing the underlying picks and shovels for agentic marketing. And that is infinitely harder to replace than a simple workflow app.
And that 15% discount to the sector median we talked about earlier, that provides a vital margin of safety. They aren't currently priced for absolute perfection.
Which offers some downside protection if the broader enterprise software sector experiences further multiple contraction.
But the timeline for this thesis playing out relies on several distinct catalysts. The primary focus for you should be the Q2 2026 earnings report coming up in August.
Because the market isn't going to wait 3 years to see the Palantir revenues. Analysts will be scrutinizing the forward guidance to see if consensus estimates require immediate upward revisions based on early integration metrics.
If management fails to demonstrate tangible pipeline growth from the foundry partnership during that August call, the institutional patience will evaporate quickly.
And the secondary catalyst is entirely macroeconomic. Broad expectations point toward the Federal Reserve executing a series of rate cuts in late 2026.
Right, and historically, as the cost of capital decreases, liquidity rotates out of defensive, large-cap safe havens and aggressively seeks yield in small to mid-cap technology and AI equities.
Which makes Zeta's current positioning a prime candidate to capture that rotational inflow.
So synthesizing everything we've looked at today, we're really looking at a masterclass in corporate evolution. Zeta Global recognized the existential threat facing traditional software margins and engineered a capital-light transformation.
By offloading their infrastructure burden onto Palantir, they created a mathematical anomaly: the ability to scale nine-figure revenues without corresponding operational drag.
They are transitioning from a marketing technology vendor into an integrated AI infrastructure powerhouse. For market participants, this represents a highly complex, multi-year hold opportunity.
If Zeta can execute on their aggressive integration roadmap and navigate the execution risks associated with Palantir's legacy client base, they are positioned to redefine the economics of enterprise marketing.
The technical tools validate the institutional interest, but the underlying fundamentals will absolutely dictate the long-term success of the pivot. That's why the current investment thesis yields a highly bullish score of 8 out of 10.
The broader implication for you, listening right now, is that the legacy categorizations of the tech sector are basically dead. The boundary separating a marketing company from an AI infrastructure company has been completely erased.
We're witnessing an extinction-level event for standalone software providers who lack proprietary data moats or Tier 1 infrastructure partnerships. In the era of autonomous agentic artificial intelligence, your foundational data layer is your only defensible asset.
Everything built on top of that is just commoditized code, which leaves us with a critical, somewhat unsettling question to explore moving forward. We've dissected how Zeta's integration with Palantir creates a hyper-efficient, untouchable baseline for enterprise marketing.
Right.
But if that level of autonomous deep data intelligence becomes the absolute minimum standard required for a modern business to compete, does the independent software as a service model even exist in 5 years?
Or is every single standalone software vendor going to be forced to surrender their proprietary tech and merge with the major AI infrastructure heavyweights just to survive?
The zero OpEx miracle we explored today might not just be a brilliant strategic partnership. It might literally be the only viable blueprint for survival in the next decade of enterprise technology.
It's definitely something you need to be watching closely in your own portfolio.
Absolutely. If you found this breakdown valuable, please consider subscribe, like, and comment underneath. And remember, if you want to track the chart levels and technical setups we discussed today, check out VIP Algos.
The link is in the description below.
Thanks for joining us on Smart Wealth with Joshua. We'll catch you on the next one.